Hey guys, good morning. I'm going to have a special video for you to go back again through the genesis of my thinking about organizing the market into distributions and walk you through the concept and then how I went about to create my little range boxes. Jeff, I asked him if it was all right to share this with you guys, and he said yes. So he's having trouble getting confidence um, with the market, not understanding what's happening. So that is very common. It can be extremely confusing. We're bombarded with all kinds of macro and experts telling us this and that, and we're getting information from many different sources. So you have to be able to cut the wheat from the chaff. And how I do that is I put together my little world, and it's called volatility. It's very, very simple concept. Here, let me get the V up here. And what we want to do is get the high and the low and the middle. And once we can do that, we can control our domain. So we don't have to become less confident. We know exactly whether a price is inside or moving to the outside here or crashing through, right? Are you in the range or did you break it and running with high volatility outside the range, up or down? So I call it in and out. I want to know where my nucleus is, and then I want to know how to get to the outside of the range and head out, because you're either going to stay inside going up and down, or you're going to break it to go to the level, or you're going to break out of that and try to expand going to common statistical levels below the range. And algos have the same football field as this is, and that's all they do. And they move from 0 to infinity. So let's take a look at what the heck am I telling you, right? You're laughing at me. Okay, so how I came up with this was reading this snippet from Wells Wilder's book, and he explains that a common method for using a stop and retrace would be if you were in a long position waiting for price. If it retraced 30%, you would exit the position for holding a long. And they were able to determine that's very back testable to hold a trend. So I thought, well, I need to see how to do that. And that's how I ended up where I am today, building my little range boxes with my indicator. And so they set it up like a bell curve. And that makes sense. Here's your 0 and here's your infinity. So if you're trading the infinity going out in a range, you don't want it to come back to the middle and sit here and churn. No telling if it's going to go to the other side or continue back in the trend. You just exit. So it made a lot of sense to me. And I started, looking into the bell curve and realized that if you get outside this one, the only place for a range to go is to the 2 or the 3. That's it. Or turn around, go back to the other side. So if you know that the algos are going to spend the majority of their time inside this area here, you can become very adept at trading in and out of the 68%. If you can position yourself on a higher time frame, for instance, like a weekly or daily time frame, where we've moved out of the middle towards the edge, and you're inside this area you can capitalize on the slope of, I call it the volatility slope. I grabbed that, I'll show it to you in just a second, going and expanding out of that range at that time. So you know you don't have to worry about what anybody's telling you on TV or whatever, or on FinTwit. You know that the range is expanding and going out, and you just try to catch that ride, surf that slope to your range opportunities, wherever that is. And if you can match these range levels out here in the wings with something else, a confluence of a prior swing high or low, a volume profile level, whatever you use, high volume is very, price will go to high volume, whether it be an option, put, or just regular volume stack there. So, marrying these levels with other levels is very important. The confluence, prior date, open, high, low, close, a floor pivot, whatever you can find. Uh, Here's just a little bit more information about these charts. And this is my 1, 2, 3 system. So you hear me talk about PT1, PT2, PT3. This is it right here. This is what I do. And so I'll capture um, 1, 2, and 3 for targets, and I'll trade to 1, to 2, or to 3, or I'll use the threshold value inside that 1, 2, or 3 to determine stops and profit targets. And also, what is even more, important is to recognize how to capture a range for a period. So whether you're looking for the past 14 periods or 20 or 50, it's got to be customizable so that you can move in and out of these distributions and time frames as well, to go to the higher time frame weight. It's much better to be hitting the weekly slope as it's moving out than it is on a, 5-minute chart, because that's not going to last very long. So the bigger ranges that you can put yourself in, the better. But just getting this concept, weekly, daily, you can also break it down into Globex and RTH session. So you can get an idea of what your ranges are for the period of time in Globex that you want to, examine, maybe the last 20 periods or 14 periods or 10 periods or whatever you like, and see what that is on average, and you have an idea of whether you're inside that perimeter or outside. That's all you need to know. Am I in that range or am I out of that range? If you're out of the range, is your range expanding and the candles, the ATR is picking up, giving you a ride outside that range? Or are your candles little tiny candles floating along? And when the second part of my indicator is the deceleration, and when the range decelerates following a range expansion, that gives you that lift and upward drift. I separate my indicators into range opportunities, whether the range is contracting or expanding, and on also the threshold of the volatility, whether we have low volatility or high volatility. And if you just want to go range expansion high with a short, I can do that. So the way I break markets down, I don't care what anybody is saying. I want to know, is my range expanding, contracting, and how am I going to approach that and trade it? I also measure the range by, I showed you the low or high vol, whether it's expanding or contracting within the low or high vol, because this is important. If you can just scrunch your chart up and have a method, put ATR on it or something, and you just find the low volatility, right? And you know that if you're below that line, then you're going to expect to see an X behavior and learn to capture that behavior inside that condition. Now, when you're high vol, on the other hand, be able to capture that and then trade accordingly to whether your range is expanding or contracting. Once it starts contracting, you're not going to go short anymore on range contraction. That's one thing I say over and over on Twitter. It's like it's contracting. It's not just because you have a red bar doesn't mean it's going to keep going down. It's going to come back up. And also, when you get to the end of a range, it's not going to keep going. And how do you know when it's at the end of a range? Well, if you have a way to measure volatility, you know where those spikes are, right? That's one way. So you know your hot overbought oversold zones, and you know for a fact once that starts decelerating what you're going to get. And that's that bounce up. And algos do this over and over and over and over again. So find your ranges, and I'll show you my method of the being able to grab whether it's a Globex range or a daily range or an opening range. This is a daily with tails, and I can put tails below the range of any Fibonacci level. So I can take any custom range I want and divide it up. Daily, yeah, 1 hour initial balance. And I'm sorry, what happened here? Hit the button. Okay. So get the picture of that bell curve in your mind and visualize that if we were in the middle of the range, it's going to go. Let me get this box out of here. It's going to leave the middle of the range and it's going to go to the 1 and the 2. Do you see how that did that? And then it's at the end of the range. So it doesn't always, I mean, it doesn't go to the tail necessarily. It'll just flatten out, come back in, flatten, flatten, flatten. That's your little range walk here in the Globex session. But it did leave the session, went to the 3, and then just sideways tracked. The algos know where these ranges are, and I do too. It set it up like a bell curve. And they go to these Fibonacci levels, the same levels over and over. It's very algorithmic. So if I'm breaking the 1 with range expansion, then I know that I want to go to the 2 and to the 3. And break the 1, go to the 2, go to the 3. This went to the first fib and then turned around. You can use it as a stop and reverse, but I don't. I just trade to the target. If you do get an early signal, though, say this was like at 10 o'clock in the morning or 9 in the morning, you might consider that bounce back to the mean because you'd have a higher likelihood of it, RTMing all the way back to the middle. But at the end of the session, that's not going to happen. It's just going to sit there. Depends on your time frame. But you want to be able to know your range highs and lows, what that looks like, measure what's high, medium, low, and be able to tell if you're leaving that range or going back in. That's it. And I think that if you break your ranges down like I'm doing, it's going to be very helpful for you. It helped me tremendously. I can also put other ranges inside of this. So here's yesterday. So in the middle of the daily range, went to the 1, went to the 2, went to the 3, walked sideways on deceleration. So this is the part that I was seeing and telling everybody when I was doing my Twitter shit posting that the move was over, because I was seeing this. You don't sell on downslope deceleration. Um, it's not going to go far. It's going to come back. You're going to get you might get one candle in, but it'll turn right back around and take it right back from you. I like to have a range expansion out of a range. And so I can set up just to trade this and then just sit out of this. Now here we had a little bit of a deceleration, I mean an acceleration range expansion, and it went when the range accelerated. Right here you can see it accelerating. Once it started accelerating, it was able to finally go from the 2 to the tail, 3 to the tail. So it left the 3 and went to the tail. And as soon as it hit this tail, look at this. These levels I don't change. These are on my chart all the time. My first fib. Went right back in. And that's because this is all weak. It's a weak low. You want that range expansion to hold to get you to these outer targets. Now, having told you this, if it gets to be on the other side of that distribution and we're going long, you can go long on range deceleration. In fact, you want to go long on range deceleration. And that was hard for me to wrap my head around. I want to see range acceleration leave a range, right? This is a nice, healthy range expansion walking out to the target. But if you get to the upside of the distribution, you can absolutely, let's see if we can find one that left the upside real quick. We put this on 30-minute. Here we go, right here. So we went to the upside, but it was on expansion. And you just kept expanding and it came all the way back down. So that was a nice coast to coast. And you'll hear me say that because these algos love coast to coast. So you go from the 1 fib to the 1 fib. Oh, it was a 2 fib. Never mind. It did get there, but it kept going. That was a coast to coast, but it just kept going and then turned around. Very nice move. This is the part of the distribution that has to be hedged. When it breaks the daily range right here, so anything below your daily range is a hedge. And when it gets outside of the first box, look how algorithmic that is. 2 times the range. When it got outside of that first box, then you, I mean, have to, realize that that was a stay with the down move. Don't try to do the RTM. Here was a little contraction here, but it did not go anywhere. The fib held. And more expansion pushing it down. So just find your own way to put your boxes on your chart like I did, or come to my website. The indicator is available for NinjaTrader 8. And or learn to code and draw your own, like I have done. Let me show you the 1 minute opening range. Excuse me, the 60-minute opening range. And then the 1 minute opening range. Hold on just a second. I've got two of them. All right, so here's your 60-minute range of the first hour of trading, and that's yellow. And let me minimize, make that, there we go. So it's the same concept as the daily, but we're using the first hour of the trade session. And when it breaks that first hour, it's really going to be moving. So this one was a good example. Came down, found the lower fib. You can create, I mean, if you get my indicator, you can put your own fibs on here below whatever you would like to draw, and put them in different locations. After the 1, 2, or 3, you can draw them out. But when you get even below, your lower fibs, getting into a full range, that's when I stop using the 1 hour IB fibs, and I want to trade to the daily fibs. And that, put it back on the chart. That gives you your target to leave the 1 hour IB fib and go to your dailies targets. So you can make sure that you're going to hit a line, is what I'm trying to say. Sometimes it'll be inside of a daily range and not hit anything, but you can always put a smaller time frame range in there and get a line to trade to. Targets. All right, so I don't know if that makes sense, but I can likewise know the percentage and back up once I hit 30% or 60% or whatever in Blackbird using this method for stops and targets using any percentage of the thresholds. And likewise, condition my trades, whether I'm low, medium, or high. And I started to show you that low is the low drift. And this is what most of the long-term investors want to trade. They just want that pattern. Very easy to get for them on these signals, and set it up so that you're getting the inflections after a short retracement, getting back in on these inflections in the direction of your drift. And then again here went to this fib target right there. Just give yourself a target to trade to. So you can divide the ranges and put them into fib boxes like I have, and that way you're not worrying about what anybody's saying anywhere. You know that if it's leaving a range, what your plan to do is, and if you do want to stop and reverse and come back into the middle of the chart, you could set up an algo to do that too. I wanted to show you in Bloodhound how easy it is to get that low drift deceleration. So let me put this back up. Here's a good example. When the range is decelerating with my threshold solver, very, very easily with the long-short modifier. put a long condition, and likewise you can change it to a short. So here we're just getting the threshold short. So if you're just getting the threshold short, you don't want to take shorts. We do not want to short. And so right here is the low drifts long. This is the template, just raw. This is just threshold, low, um, decelerating volatility, go long, right there. It's not any more difficult than that, and that's what most of the time you want to trade in a normal trading environment when the markets are going long, risk on. And when it's risk off, you want to be flipping this around and trading long vol short. Um, with momentum, and there you go. And so the template will set up for you long vol or short. So it helps you take the guesswork out of it. And so once your template is set up automatically, just trading volatility, you go to your targets. That's all you have to do is worry about where are you going to get in and out. Okay. Thank you so much. I hope this helped. And sorry for the long video. Y'all take care.